Well, it's interesting when you look at across the economy, there are elements of the economy that aren't doing great. In fact, the manufacturing part of the economy is in a recession. The good news is that's only 5 to 7% of our economy. 80% of our economy, the consumer part of our economy, is doing quite well. We think that's going to continue to fuel growth in the United States. Just look at the labor market, adding 200,000 jobs per month. Look at home values continuing to appreciate. Those all are the fuel that helps to drive consumers and drive them into the marketplace to spend. We think it's the consumer, the strength of the consumer, that's going to end up fueling this economy and be the growth of GDP in 2016. So when we think about investment routines, and we think about routines in general, we oftentimes think about the mundane, things like chores. But when we think about stress, when stress comes into the marketplace, oftentimes the first thing we do is abandon our investment routines. And what we really need to do is not make sure that we go back to old routines, it's that we keep our investment routines. What's a couple of them? Number one is have a plan. Have a plan and stick to it. The second one is to stay focused. Over our lifetime, we're going to have 9,000 down market days. That's a lot of down market days. That's a lot of red, and very few of them are going to be Lehman Brothers moments. So stay focused. Over our life, we'll see 13 recessions, 25 bear markets, and more corrections than we could count. And so staying focused, staying to a plan, those investment routines are really going to be the ones that get us and make sure that we have great success. Well, there certainly are some new routines we need to add, especially as we get later into the economic cycle. The first one is that volatility is on the rise, and we have to be ready for volatility. Tune down the noise a little bit and stay invested and stay with your plan. The second thing is we need to reframe fixed income. It's not that bonds and fixed income aren't a key component of your portfolio at all points in time, but we've had a love affair with fixed income. Over the last 30 years, bonds have been in a bull market. As yields continue to move lower, as interest rates move lower, prices has continued to move higher. But we're moving into a new paradigm. The Federal Reserve is going to begin to raise rates, and we're going to have to rethink, have a new routine of how we look at fixed income. But the most important thing, without a doubt, is to keep the old routine, having a perspective, having a plan, and having patience. So the interesting thing about oil is it's really driven by two things. Number one is supply and demand, and number two is the dollar. As the dollar begins to appreciate, anything that is priced in dollars decline in value. Those are things like commodities, oil and gold. And so therefore, as the dollar has appreciated, put great pressure on the price of oil. But we think that what's going to happen is that the dollar is going to stabilize here. It's going to drift higher, but not dramatically higher, which will end up putting somewhat of a floor on oil prices. The second is supply and demand. What a lot of people don't realize is that we're using more oil than we ever have. We're driving more miles than we ever have, and we're utilizing that. Demand is still good. It's a supply issue. The U.S. energy renaissance has added so much new supply. That's good for the U.S. as we become more energy independent. But that extra supply has put a lot onto the marketplace and therefore driven in a supply-demand way the price of oil down. We think that over time that supply adjustment will happen. We'll provide less supply and strong demand will still be there, and we'll find a much better price equilibrium. We think prices for oil will find a bottom here in 2016 and drift higher, maybe even dramatically higher. But we're probably not going to see $100 oil anytime soon because there's just too much supply. But the demand remains strong, and we're certainly bullish on the energy sector.